Okay, everybody, it is that time. Welcome to the Fats, Fuels, and Oils webinar for February 28th. This week, we are going to cover vegetable oils. I know typically we would have covered the fats and greases after we missed them last week, but given what's going on in the soybean oil market, I figured that it probably was best to talk about what we think is going on in the vegetable oil markets this week. All right, so let's get started here. Prices last week were up about 6 cents, and that's been driven by a combination of bullish world fundamentals is a sort of steady backdrop over the last couple of months. And then obviously the Russian invasion of Ukraine sparked a big rally in energy prices and drove concerns about the loss of sunflower oil from the Ukraine. Now, typically, I think what I would say in a situation where there's some disruption in trade is that, okay, well, the Ukraine isn't going to send sunflower oil, or the Ukraine and Russia aren't going to send sunflower oil to their normal trading partners. But really what happens is it's just sort of a shift in trade flows. And so they'll send more of their sunflower oil to places like China, and then that will reduce China's imports of other vegetable oils, and the places that they don't send sunflower oil to will sort of backfill, and there's some disruption, and so there's some price impact, but it's not as large an impact as you might expect at first glance. However, this situation is one where it seems likely that that Ukrainian and Russian sunflower oil exports will be dramatically diminished by the war in Ukraine. Obviously, farmers in Ukraine probably aren't going to be planting sunflowers this year unless somehow this thing is wrapped up peacefully in the relatively near future. It's getting close to planting time for those guys. And so instead of a sort of shift in trade flows, it seems more likely that this is just a reduction in the world supply of vegetable oils. And again, given how tight world fundamentals were already, any reduction is going to be really supportive of prices and drive them higher. And I think that's part of obviously that's part of why we saw prices up so much in the past week. On top of that, you still have concerns about the drought in South America and its impact on production down there. The weather pattern has shifted a little bit, and it seems like there's more rain forecast for Argentina and southern Brazil over the next couple of weeks than there has been pretty much all season. And that can help some of the late maturing crops, especially in Argentina. But in general, I think a lot of the damage has already been done. And so while this rain may keep us from continuing to reduce our forecast for soybean production in those areas, I don't think that it's going to substantially raise our forecast for soybean production in those areas. And so we still expect significantly lower output from South America than everybody did at the beginning of the year. That's also going to help continue to support prices. We still do have this kink in our forecast here, where in July, where if we get a big increase in US acreage and we get normal growing conditions during the summer, then that should help alleviate some of the supply concerns. But of course, there still is the expansion of renewable diesel production capacity, and then two, the shortfall in South America that may mean that an increase in US production is just kind of sucked up by the market. Now, if we don't get a big increase in acres, or we don't have growing conditions this summer that will support trendline yields, it's easy, I think, to make the case that soybean oil prices could go substantially higher and potentially even could reach a dollar a pound. Again, like the $20 bushel soybean forecast or thing that I said a couple weeks ago, I don't think that this is a high probability event. But if you have oil going up to $115 or $120, then you can make the argument that from a, a biofuel demand standpoint, that still works relatively well economically. And from a world fundamental standpoint, that prices will need to go to a level that will ration demand, given that one of the biggest sources of demand is mandated by the US government. That's going to be pretty hard to do. One of the things that has been most interesting over the past week has been the move in palm oil, and that the impact that palm oil has had on US soybean oil exports. So palm oil prices in the nearby contract have topped 8,500 ringgit per ton, which has sent the spread between palm oil and or soybean oil and palm oil, the March contracts, to a palm oil premium of about 10 cents or 12.5 cents, somewhere in that range. You've seen that impact directly on US soybean oil exports over the last couple of weeks, where export sales data has shown a pretty big jump in US sales. Now, we don't expect that that will continue, and we think that it looks like palm oil production is probably bottomed for the year. Malaysian coronavirus cases are on the backside of the Omicron wave. And if you look at the production estimates through the month of February, they do them every 5 days or so. If you look at those, you saw sort of lower production at the beginning of the month, and then as the coronavirus cases started to come down, a recovery in production. So the production was about 4% above where we were in January. So it looks like production probably bottomed in January, and then seasonally, of course, production picks up from here through the fall, through September or October. And so I do think that that will weigh on palm oil prices, if not the absolute price. And to be honest, I think it's kind of hard to sustain palm oil prices at 8,500, but it's hard to say because we're at record levels, and so and we have all of this stuff going on. So it's I wouldn't bet my life that we won't stay at 8,500, but at the very least, I think that it should start to move the spread back in the other direction. And then if you add on to that, ultimately, the domestic demand for US soybean oil, I think we will ultimately shut off US exports again this year like we did last year. However, given what's going on in South America, that's going to be a little bit tougher this year. We've already seen crush in Argentina slow down pretty dramatically in January. Now, this is just ahead of their harvest, so you would expect it to slow down some this time of the year anyway, as they they don't exactly run out of old crop supplies, because farmers tend to hold big stocks in Argentina. But the crushing industry tends to run lower on supplies ahead of harvest than they do after harvest, obviously. So that supply is also not where it might be otherwise. And the point really is that it's just that while the palm oil spread probably will go back to a soybean oil premium of 4 to 5 cents over the next couple of months, and then we expect it to go even higher during the third quarter as the bulk of the increase in renewable diesel demand comes online. the impact on US soybean oil exports probably isn't going to be the exact same that it was last year, where last year we just basically shut exports off. Now, last year that spread blew out to like 30 cents. And so, of course, it made sense to shut off US exports. I don't think the impact will be quite the same this summer for all of those reasons that I just listed, but also because I don't think that the spread is probably going to go back out to 30 cents, given that world vegetable oil fundamentals remain overall relatively bullish. But in the short term, I do think that ex-US exports probably remain a little bit stronger than we expected, probably even a month ago or 6 weeks ago, certainly. And I think that that period probably lasts for another month or maybe 6 weeks, something like that, until you start to see those spreads kind of get back to where they normally should be. Um, Outside of that, in canola oil, we saw weekly canola oil crushing volumes out of Canada increase, and they increase sort of seasonally during this week, but the increase wasn't as large as expected, and so we cut our estimate for February crushing volumes by 50,000 tons. That didn't mean that we needed to cut our marketing year crushing volumes, because last week we had raised them and we were concerned about maybe needing to raise our marketing year. And so this kind of offset that and just kind of took us back to where we were. And if anything, if the trend in weekly crushing continues to run just a little bit below, if the increases are a little bit smaller than we would expect seasonally, then I think we probably might even end up cutting our marketing year crush forecast for Canada. Right now we're at like 8.85 million tons. I think that we could end up a little bit closer to 8 than where we are now if that trend continues. The other interesting thing that happened in canola oil, and this is interesting only from a sort of a round numbers perspective, is the price in Los Angeles rose back above $1 for the first time in several months, and that time it like peaked above $1 and then went straight back down below $1, but sustainably since last June when it traded above $1 for a while. As a result, we raised our Canadian canola oil, or our Los Angeles canola oil price forecasts out through the third quarter. Now, we didn't raise them in the fourth quarter because we already had built in a pretty big increase during that time frame. So raising those further to keep that spread there didn't seem to make much sense right now. However, again, if the trend in Canadian crush and if US crush comes in a little bit weaker than we're expecting over the next month or so, probably we will be raising that and pushing that spread back out to, it was about 25 cents or so from sort of the average price over the second quarter to the average price over the third quarter. We probably would do that, and that would imply canola oil prices on the West Coast anyway, that approach $1.50, and that is significantly higher than we thought earlier in the year. Obviously, we were thinking that maybe $1, $1.10, $1.15, somewhere in there. But the developments have made all of our earlier in the year forecasts look kind of silly at this point. Much like soybean oil, we are anticipating a trendline yield crop for canola, and so that's why you see the big decrease in prices starting in September. Again, if we don't get a trendline yield crop, then that decrease will change pretty rapidly. And there was a prominent meteorologist that put out his spring and summer outlook over the past 2 weeks, and basically he's predicting that the U.S. Midwest and Canadian prairies and northern plains could see good rain in the spring, But then because of a couple of teleconnections, which are these broad weather patterns like La Nina or El Nino, that a high pressure ridge sets up over the western Corn Belt during the summer and restricts rainfall. Now, of course, it's easier to rain in places where it's been wet than in places where there's a drought, because part of the moisture that falls it falls as rain is actually sucked up from the ground and then returns to the ground in rain. And so the fact that the northern plains in Canadian prairies are already in a drought means that the rainfall in the spring, if that verifies, that'll be critical. If that doesn't verify, or if it's not sufficient to sort of really reverse the soil moisture levels, then it's much more likely that that the drought will continue through the summer. And if that happens, we certainly won't be um, our forecast certainly won't feature a big decline in prices starting in September. In fact, it probably will kind of go the other way as we ramp up renewable diesel production. All right, switching to biodiesel, we got the EIA data for renewable fuel production, excluding ethanol, for December, and that came in at a record 279 million gallons. That was just a little bit below our expectation based on EMTS data from the EPA, but generally in line with the recent trend, and generally in line with the EPA data. We were off by 4 or 5 million gallons, so not that much. As you can see in the chart, we expect that that production declines seasonally. And again, the EPA data sort of suggested that for January. We've got it down sort of year over year in January. That's due in part to, one, whatever the EPA data said, which the EPA data featured a decrease, but two, again, to the seasonal pattern where you get big increases in December, and then you get a drop off in January in most normal years. Last year was a little bit abnormal because we didn't really know what the mandates were. And so production during January, February, March should have been a little bit higher than we would expect in the typical normal year. But we expect big increases through the rest of the years, as you can see, as renewable diesel capacity comes online. One of the interesting things in the EIA data was the capacity data. So renewable diesel capacity expanded by roughly 90 million gallons a year to about 1.1 billion gallons in December. The more interesting part was the biodiesel production capacity data. So I think a lot of people, and I think we expected, that biodiesel capacity would start to move lower last year and sort of very slowly move lower through most of the year. And it really didn't. It actually kind of increased from January through about September. And then in September, it started to move slowly lower. But then in November and December, it dropped off quite a bit in relative terms. In December, it dropped like 145 million gallons. And given what we've seen in our estimates of biodiesel profitability for the California market, that starts to make sense, and it starts to support our idea that domestic biodiesel production is going to drop from about 1.7 billion gallons in 2021 to we're at like 1.56 billion gallons in 2022. The big question remains whether the gap between ethanol production and the ethanol mandate means that biomass-based diesel production is going to need to be higher than we anticipate. And we've built in kind of a 400 million gallon increase in biomass-based diesel production based on that idea. But if margins continue to, in part of that would be stronger biodiesel production, which may mean that our forecast for 1.56 is too low and ultimately will need to come up. But if biodiesel production capacity is going to decline, and if that decline starts to accelerate in the coming months, then I think that supports our idea of 1.56 or somewhere around there. All right, so for profitability, and this chart probably is still going to look weird. If you look at the profitability for biodiesel, that dropped last week to an 11-cent loss from a 10-cent gain, 10-cent profit the prior week. And renewable diesel rose to $1.99 from $1.90 the prior week. A lot of this has to do with the way that we have made our feedstock assumptions. So again, if you think of biodiesel really as the profitability of using soybean oil, because our biodiesel feedstock mix is 75% soybean oil, 25% yellow grease, and think of renewable diesel as the fats and grease, using fats and greases as feedstocks, and a little bit less in biodiesel and renewable diesel terms. That'll give you some sense of what a renewable diesel producer probably saw, at least in terms of trend, if they're using a lot of soybean oil for feedstock. And soybean oil prices rose dramatically. Fat and grease prices not quite as much. Our fat and our feedstock mix for renewable diesel is a combination of 50% bleachable fancy tallow, then 25% DCO, and 25% used cooking oil. We have seen probably stronger used cooking oil demand than we anticipated, and the EIA data reflected that. I think we estimated that UCO use in renewable diesel production was about 200 million pounds, maybe a little bit less than that, or maybe a little more than that, around 200 million pounds, we'll call it, in December. And so ultimately we might want to change the way that we're doing our feedstock assumptions. But again, I think if you think of this in broad terms of the trend for vegetable oils is more reflective of the biodiesel margins, and the trend for fats and greases is more reflected by the renewable diesel margin. I think that's more useful than probably looking at this and assuming that these are exact numbers, if you just kind of stick with the trend either way. Our RIN forecast didn't really change that much. I think we raised it maybe just a little bit for D4. We also raised D6 a little bit and narrowed the spread, although that spread looks a little tighter than it was supposed to be. So I'm not exactly sure what's happening there. What we really expect from the spread is that it kind of continues to narrow throughout the year. So we're at $30 or so right now between D4 and D6. And I think we get that down to like $15 or so by the end of the year. And this is a reflection of this idea that ethanol production and demand is going to be weaker than the mandate. And so you'll have extra renewable diesel or biomass-based diesel production and a shortfall in D6 RINs. And so people will produce biomass-based diesel, they'll sell those RINs, and then they'll buy D6 RINs to meet their renewable volume obligations. But no big changes in our RIN price forecast this week, and similarly, no big changes in our LCFS credit price forecast this week. I was looking at, I just finished up our quarterly outlook, and so I was looking at some detail at the LCFS program and the LCFS credit prices. I think that we thought that LCFS prices might go down and might stay down for a relatively long period over the next several years anyway, until sort of the deficit started to catch up with this big increase in renewable diesel production. One of the things that kind of surprised me is if you just looked at the annual credit in deficit creation in 2021, deficits were still above where credits were. Now we are predicting that credit generation and deficit generation will kind of match in 2022. And so we think that probably LCFS credit prices remain depressed through 2022, but then in 2023, we start to look back more like we have traditionally, which is deficits are greater than credits. And so that should support a recovery in LCFS credit prices, I think in late 2022, early 2023, if all of that continues to hold as we expect it to. So I think while our forecast is probably going to look, down into the right here for the balance of, or for most of 2022, I think it probably will start to show some real recovery in 2023 and get back to, I don't know that we're going to get back to $200 a ton, and I don't know that we're going to fall to $120 a ton. But I think in terms of the trend, I think the trend from here over the next 6 to 9 months is probably sideways or lower. And then I think you probably start to get that trend to reverse and start to see LCFS credit prices move a little bit higher as we move into 2023. All right, with that, I will stop and open it up to see if anybody has any questions this week. Doesn't look like it. All right, we will be back next week and we will cover fats and greases next week. Everybody have a great week, and I will talk to you next Tuesday. Thanks everybody for attending.